three of us look like we're exhausted or something. Are you guys okay? This has been a long day, I know. The
It really
stocks
has
got
been.
pounded today. I have some caffeine here. I'm gonna turn on my fan because it's hotter than shit in my room right here. But welcome to the
I'm
Futures Edge
polishing off an
podcast.
espresso. I'm actually
I'm
polishing off an espresso pre-show. So,
okay, good. Yeah, this should help. Mike, what about your caffeine intake? Is
oh,
it fine?
I am fine. I'm actually on a lot of vitamin B right now, so
Does
mm.
that help? Okay, I'll give that a go if you
vitamin B
need.
is very good for energy. Although this is not
Really?
a medical podcast.
Do not do not take our advice as medical advice ever.
If someone
Ever.
would take medical advice from me, they're in a world of hurt. So
I thought vitamin B was good for hangovers too, right? B12?
it is. I wouldn't know
I've
that.
never been hungover.
Well, you don't drink, Mike?
Oh, I drink.
Okay, good. Oh God, I drink. Okay, anyway, you guys know where you are. I don't have to do the intro, I guess. You've turned into the right place. It's the Future Edge podcast. Rates are screaming through the roof. I was on Kudlow show with Pete Nigerian, and a buddy of ours yesterday, and he talked about utilities being rate sensitive. I was like, dude, everything is rate sensitive when rates go up this fast, correct? Bobby, what do you think?
Yeah, that's a great point, Jimmy. And when you're looking at rates go up, and by the way, this is something we could do it now or we can do it in a few minutes. When you look at where the curve has gone, especially the 2s, 10s, this is something that Mike's done a lot of work on. And the 2s, 10s inversion is heading rapidly. I don't want to confuse people, but it's steepening rapidly. But I agree with what you said a couple weeks back, Jimmy, where it's like steep negative. Now it's flattening positive. It's not there yet. And then it can steepen again after that. So I agree with you on that. But
by the way, you told people this was going to happen and that when it was going to happen, the stock market was going to have its most difficult time. You've been saying that for a year, right?
I have, yeah. And a lot of the reason I said that, so it was muscle memory, but it was also Mike's research that told me this. So Mike, can you comment on that a little bit with the sort of reversal of the inversion of the curve?
Yeah, when the curve starts accelerating back towards zero from negative, and then especially gets above zero to about at least 25 basis points is when the market can really start suffering and faces a lot of headwinds, and historically has had some of the biggest down moves. So right now I have the 10-2s at minus 29, but that's accelerated pretty rapidly in the last, let's see, what is it? In the last 3 weeks, it's gone pretty straight up and broke above some key resistance areas.
Yeah, and look, and just the last couple of days, it's fallen higher too. And Bobby, the fundamental thing on this too is that if the stock market starts heading lower and the curve is steepening, we'll agree to call it that, whatever, and then all of a sudden we start perhaps taking out rate hikes and putting in eases again, then the front gets pummeled at the same time the back is getting. I mean, the front gets, the yields go lower in the front and higher in the back again, exacerbating the move, right?
Yeah, so that's what I wanted to say. So this is a classic situation of Mike knowing what has happened in the past, right? Not predicting what's going to happen, but knowing what has happened in the past. So right now I have the 2s, 10s inverted by 37 basis points. It looks like it might settle there. Could be off a little bit. If it settles inverted at 38, then that's the highest it's been, because remember, there's a negative number. And that's the highest it's been since March 24th of this year. But if it goes lower than that, okay, so let's say it's negative 37 or so, you have to go all the way back to late October of 2022, since it's settled that high. So I should say if it goes higher than that.
Higher than that.
That's always a confusing conversation.
Yes.
So from that perspective, Mike talks about what has happened in the past, right? And you and I, Jimmy, have talked a lot about how stocks, if we go into a recession, right, which is what the inversion of the yield curve predicts, what generally happens is stocks will start to come out toward the late stages of the beginning of the recession. Stocks will bottom and start to come out. But the inversion generally writes itself prior to a recession officially beginning or right in the very beginning of it. And that's sort of that match. So we can you and I can kind of play around with the theory as to why that happens. Because again, Mike only cares about what, which is the smartest question when you're an active investor or trader, right? What's
Yeah.
happening and what am I supposed to do about it, right?
Right. And
But the
again,
why, go ahead,
yeah.
please.
No, I was going to say the people who are watching, Bobby and I play around with the why, and we talk about fundamental analysis, but it really only makes up about 30% of our trading thesis.
Yep.
The other is price, whereas Mike
Right.
is more, 95.5, probably 98.2, right? Whereas I just like to bolster our argument with some fundamentals. But anyway, go on, Bobby.
I look at fundamentals a lot of the times brings me to the idea for a trade. And then I look at the charts myself. And if I have any confusion, I go to Mike. And Mike, honestly, in the past hasn't. And as long as I know him in the future, will be able to veto any trade that I come up with because he says the charts are disagreeing with you and then I won't do it. I
Right.
still might like the thesis, but I'll wait till the charts turn in my direction. So from a fundamental standpoint, and tell me if you think I'm nuts on this, either one of you. If the yield curve is going, let's call it normalizing, so we don't have to go with flattening and steepening, right?
Good.
If it's normalizing to where the 10-year yield is now going to be higher than the 2-year yield, or pick any area of the curve you want, then that theoretically means that down the road, inflation will be stronger than it is in the short term. Or what? Or the Fed's going to cut rates on the short end and it's going to grow the economy on the longer end, right? Are those the only two?
Well, the movement we've seen has been specifically on the long end. So that part about the market saying that the Fed is going to cut rates, if people believed that, I think we would have seen it in the 2-year, and we haven't. So I think that there's a couple things at play. One, the market is believing the Fed of the higher for longer soft landing bullshit, which I don't necessarily believe. But secondly, when money supply is contracted 5% and issuance has gone up so dramatically, there's just a kind of an imbalance as the Fed goes to sell bonds. The belief is that the buyers will be at a lower level, I think, just because of the lack of money supply. Plus the fact that when the president is out on the UAW strike saying that 40% raise seems reasonable. Kaiser Permanente, 75,000 health workers going on strike as well. If we start to see the wage portion of the inflation, the whole notion of it, that could be the worst part. Because remember, the wage price spiral is what we wanted to avoid, particularly the union wage price spiral, because that doesn't write itself as easy as normal wages in the macroeconomic conditions. So I think those are the things that are forcing just this huge spike in long end rates. Does that make sense?
It does. And just to illustrate Jimmy's point, and then I'll go to Mike, the 2-year in the last, let's say since, again, we're recording on Tuesday, October 3rd. So you guys will be hearing this almost a week later, not quite a week later. And at this point, if you go to the end of August to now, the 2-year yield's up 25 basis points, but the 5-year's up 52, the 10-year's up 67, and the 30-year's up 69. So it's definitely not as prevalent in the front of the curve, although they're certainly not putting a rate cut into the 2-year. And that's not where Jimmy's talking about. Jimmy's always talking about more the SOFR curve and things like that. But we have seen the probability of stable rates drop over the last 3 weeks at this next November meeting. So as of right now, again, this is Tuesday afternoon, 72.3% of no change at the November meeting and a 27.6% chance of a hike. Whereas you go back to September 26th and it was 83-33. So it's actually, they're not pricing in a hike by any stretch of the imagination, but the market's starting to move in that direction. Mike, you have any opinion on like the fundamental as to why this happens?
Actually, I don't.
Now there you go, 99.1, Jim. It's 99.1% fundamental.
And this is exactly why I have to, I'll consider, like you said, Bob, I'll consider fundamentals from a long-term perspective. All right. Like we were talking about the potentially bear steepening and going, we started bringing that up over a year ago. the timing's the hard part. And then, maybe if you ask me next week, I might have a theory behind it. But I've been wondering because the 10-year has been on a tear the last 2 days.
Mhm.
In terms of yield going up, and I don't have a fundamental reason. Now, longer term, I thought this was going to happen with more as the Fed started to cut or started to ease, but that's obviously not the case. So, but this is where if I get hung up on the why, it's going to preclude me from taking action because, I don't know why something's happening does not make it any worse a trade. It's, even fundamentally, where you've said in the past, I've talked you out of trades. Look, and it might just be on the timing. Yeah, I might agree completely with you fundamentally, but as the charts say it's not time yet, then it's not time yet. That's all.
It's actually the classic example I always tell in here. And by the way, again, just to illustrate Mike's point, in the last 2 days, the 10-year's up 22 basis points. By the way, so is the 30-year. That's just the past 2 sessions.
Yeah.
I now have the settlements. That's what time it is now. So I now have the settlement. So I can say that the 2s, 10s inversion settled at its highest level going all the way back to October of 2022. It's negative 30.
By the way, is that a crude chart you have up?
That's a yield chart.
No, that's
right?
the 10-2.
Oh, that's the yield chart. Okay, good, because
Wait, that's
then
the
let's
spread, Mike?
dissect that. Today on CNBC, Rick Santelli, who's basically, he's a good guy. I love Rick. We've known him for a long time. He's talking about 10-year going to 13%. Is he high? What do you think?
Come on.
Come on.
I like Rick as a person, man. When you talk to him, he is a joy to talk to. But
Yeah,
some
he's a
of the
wonderful
times
guy.
he says things on TV, and I'm like, I've had conversations with you. You're way too intelligent to think that.
Yeah, I don't think there's any chance of 10 years, 13%. Famous last words, I'm sure, but I don't
Now
think there's
we're
any
going.
chance of it. I think our system would break.
13%.
Mike, this is the yield curve, right? This is the 2s, 10s.
Yes.
Can you put up a 10-year yield chart? Do you have that, Andy?
Sure. I have a 10-year yield right here. There you go.
All right. So even if it's a 10% chance of some sort of bullish breakout you don't have on the chart already, what's the highest you can predict with any certainty that the chart might reach if it continues?
If it continues, well, we're going to get a pause in here at some point. But if this continues and picks up steam, the next harmonic projection is virtually 5%, 5.02. But I just go, I've had that on the chart since back after last October as a possibility, and that possibility is something going. That's not. I even thought 4.686, which was the level before that, was not going to happen, and we took out that yesterday.
Yeah, my call for this year was a 4.5% 10-year, and it's past that already.
Exploded to it.
By the way, for those of you that hear us talk basis points, I've been told in the past to talk percentages, not basis points, but it's just natural for us to talk that way. Rick is talking about 800 basis points past Mike's next harmonic. So 800 basis points is 8%, right? 100 basis points is 1%. For every 50 basis points is 0.5%.
Which yield was he talking about? Sorry to interrupt.
I think 10-year. I heard this secondhand. So if someone's watched this and goes, I heard what he said, it's bullshit. He didn't say that.
Thing, right?
There might have been some context too. Yeah. I want to add something real quick before we talk about this, is that I always talk about how the psychological numbers, the big round numbers, are really, really important in interest rate things, because it just think about it this way. That's where all the open interest is. If you're putting on a trade 6 months ago for options that are expiring in 6 months, you're not going to say, I'm predicting a 4.95% yield. You'll center it at 5. You put on the call fly for a 5% yield. So tends to be a shit ton of options expiring at the big round numbers, particularly in these heavily, heavily traded assets like U.S. Treasuries.
Mike, on the last show, showed us a weekly NASDAQ 100 futures chart, or it might have been QQQs, but I want to go with NASDAQ 100.
NASDAQ 100.
Remember, Jimmy, we talked about this on the Trader's Edge, right? It was a live show that we do on Wednesdays, 3 p.m. And we were talking about it in depth. So I'd like Mike to kind of update us on where this is, because we came close.
We did come close.
Well, we haven't triggered it on a weekly officially. We closed below it on the daily back at the end of September, Tuesday the 26th. And again, I have a back adjusted rolled charts at this point, so that's one of the things I have to update the levels every so often. But we've also on the NASDAQ at this point, if I call up a weekly, it's a sloppy head and shoulders with an ill-formed left shoulder. But if this plays out, and I'm still charting this for the longer term, we could see the NASDAQ potentially head back to 13,550 over the next bit. Now, in the shorter term, I'm coming in watching for the markets within the next week and a half to set up some kind of probably a medium term bottom that will then, unless we can take out some very key levels, like getting a close in the NASDAQ back above about 15.8. I'm watching for the next rollover play after some kind of significant bounce. So it'd just be looking for a bottom coming up. Now, this could be invalidated by the time this show drops, but we do have a potential double bottom, which is nowhere near triggering yet, but it was set up today. So that could be the impetus. Again, I don't know why we're going to also go into, the potential at some point for the end of the year rally, which I don't think if we go into an end of year rally, I don't think it was going to make it all the way through to the end of the year.
When you talk about the overall trend here itself, you've got a downward sloping channel drawn on here.
Mm-hmm.
And it's not strict. It's just sort of an overall, the shape of the trend, right? More or less.
Right.
Do you see that lower trend line? That's not a buy level for people, right? That's just like a soft target where it might reach to.
You can see it's roughly a best fit line based off the weeklies. That gives me an area to watch.
Okay.
So I'll watch that area again, since it's not, even trend lines aren't necessarily hard walls. We see key support resistance. It's not like you can say it supports at 15.5. And so if it goes to 15.499, it's broken. It's an area. We watch for stuff. And I watch for things in an area. For example, on this chart, which is the weekly NASDAQ, if we head down towards the bottom of this channel, I'm roughly looking, if we keep going lower, between about 14.6 to about 14.525. Maybe if we really push lower to 14.460 in a worst case before a bounce. But this gives me a couple of areas to watch for on the weekly, and then I'll go down to the daily chart and say, hey, we've got a potential reversal setup. So if that is triggered, then that's something to act on. It gives me it's where I'm going on my extended road trip. It gives me waypoints that I'm going to be like, I got to fill up, when I hit this location, I'm going to look for gas stations.
So do you have the 50 and the 200 on this weekly as well? The 50,
the 50 and the 200 on the weekly.
This is always something I like to look, if you can kind of compress this a little bit.
Yeah.
When you look at where that channel is, that's the 50, the green one, right?
The 50 is coming right here.
So if Mike were drawing in candlesticks, right, and goes, we could go down here, we could go down here. As you go forward into the future, you can see that the 50 kind of comes in line with his best fit, the lower end of his best fit channel, which is always a thing that has amazed me about technical analysis. Again, I always reference when Scott Nations, who is a really good guy, when I was on CNBC with him one time, and my job was technical and his job was fundamental. My job was levels. They used to do that to us, Jimmy.
Yep. Oh, sure.
And I got done with the levels, and Scott's like, it just looks like a bunch of lines and squiggles. And I was like, well, those lines and squiggles match up at strange places. People will see a confluence of things and they'll put on larger positions. That's incorrect in my view, right? Because I don't care. A confluence doesn't make your 70% probability process get to 80 or 90 or 100. It just matches up a couple of things that have independent probabilities, right, Mike?
Correct.
They don't combine to be 120% probable if they're both 60% probable.
No, it's not additive.
So the same thing with that 200, Jimmy. If you look, the 200 is going to be close to the target on this sloppy weekly head and shoulders. It's going to continue to go up because it's a 200. It's not going to turn on a dime like the shorter period ones do, right? And you could see a scenario, and this is what happens with me. Like when I see something technically, like Jimmy said earlier, I look at the fundamentals and I think, okay, do I have a thesis here? And if I do, then I start looking at the charts. But sometimes I don't have a thesis. Sometimes I drank too much the night before. I ate too much sugar. I had a triple bun burger with too many carb fries, and I can't think. So I look at the charts and something strikes me. This strikes me. because Cameron Dawson, a few weeks back in her note, Cameron Dawson, the chief investment officer of New Edge Wealth, who's a huge friend of our show, she came on, and not our show, but a different show, and said that the NASDAQ, the S&P, the Dow, and the Russell was already through its 200, but the S&P and the Dow could easily get to their 200s without breaking anyone's back, but the NASDAQ was really far. And she thought the NASDAQ would really have to struggle to get down to its 200. But yet we're sort of saying it's high probability that it's going to get to its 200 if we get that weekly close, right?
So, Mike, I want to add to that question. Let's say that we are looking for a spot to short it. What series of events could happen to short it with a target that 200-day?
If we can close, especially close below about 14.8 this week, that will get me more aggressive looking for setups on the short side again after a bounce. What I'd like to see is some kind of bounce that would take us. It could even be a stronger bounce, but up on the channel line, all right, it's a little hard to see because I have a couple lines, but you see these purple ones here that I'm pointing out?
Mm-hmm. Yeah.
Now, that's around the bounce from, we could make a slight lower low this week than last week, but assuming we don't, that's roughly between the 50 and the 62.5 from retracement from when we touched the channel line last to last week's lows. Between the 50 and the 62.5 harmonics is a major rollover area. If you could see, let's say we bounce for 2 or 3 weeks, that could put us back to this descending channel line area and somewhere between the 50 and the 62.5. So we could get, starting people will say, hey, look, we're getting an end of year rally. Everything's hunky dory, hunky dory, hunky dory. And then we stall out here. We get another short signal. And then I'll be looking for the breakdown play that the first target will be around that 14.3. And the next target area will be the 50% pullback from the lows last October to the highs this July. That 50% is going to be a magnet. You have the head and shoulders target right in that area. You have the 200, which will be closing in on that area. And remember, we were sort of choppy. Then in March and April, we went sideways for 1, 2, 3, 4, 5, 6 weeks, really. And then we started the middle of May. Look, May 15th, the week of my birthday, the markets went nuts. So
they love your birthday.
Visit those levels, which, I mean, just because everything's lining up there does not mean it has to happen, but that gives me a fantastic target area for the next major roll.
And that's 13 what? 13.5, 13.6?
13.550, 13.6. Yeah, somewhere in there.
Okay.
Now, here's the thing I want to point out. The third quarter, historically, typically, is strong, is positive. But because this is a weekly chart, this could play out like this. The rally back up to the upper trend line could be January 10th of next year, right? So it could really play out over time because weekly charts, their patterns take a long time to develop. If you just look how long it took this pattern to develop, confirm, and we're still not triggered, right? You just look at it. I'm just glancing at it. It looks about 12 to 16 weeks. Like it took that long for that to happen. You go 12 to 16 weeks from now, we're approaching next year. So this doesn't have to conflict with people, that have always also been on the show. Like, who's that guy? God, I love him too. Derek something or other. I call him Mr. Brightside. He's on Twitter all the time, always telling people how things can go up because this is what happened the last 20 times. Ryan Dietrich.
Ryan Dietrich. Yeah, right.
He's fantastic. He's been on the show. We got to get him back on.
Yeah,
this
I know.
And
he's a good man.
Yeah, this doesn't have to conflict with anything he's going to put up of how good the third quarter is because historically it is good, right? But it could play out in a couple of weeks. It could play out in a couple of months. It may not play out at all. There's a lot of ifs here. But if all of these things fall into place, it's a nice, solid, short position that you could feel good about being in. Longer term.
Good. Now, speaking of, so you guys all know, everybody who's listening, because I've talked about it in Tedium, how I put on my short hedges with the 1x3s, which turned into 1x4s because I kind of traded around them on some of the rallies. So now I made good money on that stuff today, and I took about a third of the position off. But then what I did, because But the end of the week, and this is back to the S&Ps now, because I was worried about, leaving some money on the table. I did put on some put flies that have 4,200 as the midpoint for these Friday options. Now, this is a completely selfish question because this podcast is coming out on Monday when those options expire. But I need to know on a short-term basis if you like that 4,200 level, Mike Arnold. Is there anything to it?
Besides it being a nice round number,
Nice round number.
my next target is 42.36, where we're coming to, and then beyond that, it's 41.73 are my next two targets.
So either one, because it's a 30 wide either way. So either way, those don't really work for me, except that I've already made money on the trade as it's come down because it has a delta to the downside because it's a little bit imbalanced. But okay, we don't need to. Bobby, what else should we look at?
So I wanted to go through a bunch of sectors. And if we just go sector by sector and just kind of get Mike's opinion on it. This is kind of funny. What I was just thinking as you guys were talking about the levels here? I obviously would never compare this podcast to the Joe Rogan experience because obviously
because we're more fun and we talk faster.
Yeah, it would be
his podcast. I love him, but it's boring. It's 3 hours. It can be boring.
It's long, but so I'll tell you what it is. When we talk about markets this in depth and what the trades we want to do, that's when he's talking about MMA. That's the comparable, right? So very few people will pay attention to this entire show except the hardcore market guys.
Hardcore guys, right?
And then we go off, we go off the rails, like we get Robert Malone or Vivek Ramaswamy or something like that and kind of go off the rails with it. But those shows are fun too. But anyway, let's just go down the list of sectors you got there, Mike, and we'll get as far as we can before we run out of time.
I'll go fairly quickly, and I'm going to focus more so on the weekly charts. But this one I got to do XLE, and these are the sectors I watch on a regular basis to sort of get the broad take on the market and what's leading, what's lagging. But XLE, the energy sector, on a daily has triggered a channeling double top, which is not as high probability, but I'm still going to be watching, especially if crude continues. Crude's been on a tear up. We should at least get a consolidation or a partial pullback before I think it could make another leg higher. But the XLE has triggered at least a bearish pattern where we could continue to see some pullback in the energy sector even after some bounces.
Well, when I was on Cudlow the other day, I thought that the crude move, particularly was like at 94, I thought that was enough for now. Yeah. And I thought it could fall back in, perhaps test 80 even again.
Yeah.
And I think I got that mostly from you as well. I was so confident about it as if it was my own. You still believe that, right?
I do. In the last two TV interviews where they asked me about crude oil, one was Bloomberg Canada. I think the other one was TD Ameritrade, I believe. I've told them both for weeks that I was not in. Carly Garner predicts $100 a barrel. Carly's wicked smart, but I disagree on 100. And Goldman has 107. The problem with Goldman's target of 107 is that can happen next July, and they'll say they were right.
Yeah, of course.
From my perspective, this initial move, I thought it was going to cap out around 92.50. That's where I put my target on my trade. I got out of everything at 91 just to fall a little short of it. It was well above the 2-to-1 risk to reward that I normally look for. So I got out about 91 and then 91 and a quarter. And then would we shoot up to, I think it was 93.80 or 94 or something.
I thought there was one little rocket higher.
Yeah, one little rocket. And then this move, this here makes sense to me. So I like Mike's chart. This move makes sense to me that we're coming off because interestingly enough, if you look at, like, for example, you can look at the CBOE's oil volatility index, the OVX, or you can look at the CME CVOL. I've been looking more at the CME CVOL because it's easier to read in my view. Volatility in crude oil is a positive correlation with price. So when crude volatility is going up, that means price is going up, and crude volatility is going down. Not always. If it's collapsing, then the vol is going up. But the reason that doesn't happen is you generally don't get growth in oil supply that explodes, right? It's not like the Beverly Hillbillies where there's a bubble in crude. Crude oil supply generally builds slowly and demand generally falls off slowly. But the opposite isn't true for up moves. Supply is usually disrupted. And that's why you get these rocket moves, and that's when the vol goes up. And vol has been going down over the last week or so.
Okay, interesting.
And I'm watching I'm watching just in terms of crude. I'm watching for the bigger
Yeah.
pullback, even after any bounce we get around here. I'm watching for a pullback between 83.75 and 86.
Perfect.
Okay.
What
So
is
my 80, which I just thumbnailed, yeah, which I mean, I even presented it as thumbnail, is not completely outrageous.
No.
No, not at all.
No.
I think it's
Okay,
more
good.
likely than 100 at this point in the short
Well,
term.
yes, and that's why I disagree with you in the medium term. I might disagree with you in the medium term because I do think it's going to 100, and I think that they're going to Saudis and the Russians are going to put the screws to us huge. And by the way, the fundamental analysis thing too. Like for me, it was just the fundamental story. These markets that are heavily traded, they swing like pendulums, and when people chase price, they get to a point that the fundamental story does not support. And it didn't support it at 94, particularly if we're going into what I think is, that has to be utilities, right?
No, that's real estate.
Oh, real estate. Yeah, shit.
There you
Right,
go.
okay.
Real estate closed again below a very key level, roughly around that 35. I'm now my next major target over the next few couple months is back down to 28s, which could take us into the range of COVID lows, not the exact COVID low, but into the range of COVID lows. So I'm watching for any rollovers in real estate on any real estate bounces for the next few months. Any rallies should be sold. XLF, which is the financials, just broke out of a channeling flag. And this week it looks, unless we get a massive rally coming back this week, with back above 33, looks like it'll close below that. We've reconvened with the 200 area, which that'll be interesting to see how this next week. So by the time this drops, what we'll have known what happens. But you can see July of 22, we found support at that 200. October 22, again, May 23, and now we're flirting with this area again. If we eventually lose this area and can't regain the channel, which would be back to about 34, then I'm watching for easily a retest of this triple bottoms right around 30 in the XLF, and then those eventually breaking. So those, unless even on a bounce here, unless it's a really strong bounce, going to be watching for more rollover plays in financials. XLK, technology.
Can I say something real quick about financials real quick? Because we said real estate, which the obvious fundamental story of real estate is raising rates. Mortgages going from 3% to 8%. What is interesting about financials is financials usually do well in a raising rate environment, but not when rates rocket the way they have, and we worry about what they have on their balance sheet that they might be sucking wind on. That's all I wanted to put in there.
Right. And the XLRE, by the way, the real estate fund, I just pulled it up here, and their top 10 holdings are all commercial real estate companies.
Oh, shit.
So things like Simon Property Groups, American Tower, CoStar Group, Realty Income Corp, Welltower, those are all commercial groups.
So I'm asking this question because, of course, my lawyers, I don't recommend any ETFs or stocks. Bobby, are you saying that to look to something, if you wanted to short the commercial real estate market, which is something you've said before, is where you think the fissures are in this economy?
Yeah.
That's the thing you might be looking at?
This would be my favorite one because it's the number 2 ETF for real estate in terms of liquidity.
It's XLRE?
XLRE. And, it's the S&P Spider one. It's going to be the most representative of commercial real estate, and it's very, very liquid.
Got it.
Technology has also not yet, it's confirmed, but not yet triggered a channeling a double top. It'll be interesting this week, we'll know, but if this does trigger, then I'll get on any bounces, specifically waiting for bounces. I will watch for rollover plays in technology over the next few weeks. The trigger point, if you're following along for the XLK, has to be a weekly close below 162.94. Else it's not officially triggered yet. But that can hold, it doesn't have to trigger this week. It could be even in the next couple weeks. So that's technology, and that could take us all the way back to that key, as I've talked about before, between the 50 and the 62.5 harmonics. So over the next, we could have that triggered by the start of next year. We could see some lower price action in technology. XLI, industrial.
What's industrials? Oh, got it.
Yeah, the XLI industrials. We're closing in on a very strong support level. Right now, we're trading about 99.69. 97 is a very strong support level. If 97 breaks, then watch out. Then we could see a pretty quick trip to that 200, and we would have broken a major support base. I'm looking for that support base in the next little bit to get tested and then to see how it reacts there. But there was a ton. It took a long time to build a base there that it launched again in May. It broke out of that base, and we've already fallen back into that base area. So again, anything in industrials I will watch for rollover plays, especially since we have the first cross of the weekly rotation zone.
Bobby, I got a question for you. So
Sure.
if this industrials and it breaks that and starts to head precipitously lower, that has to coincide with some sort of nasty recession talk, right? These other things don't necessarily need that, but that does, right?
Yeah, the other ones could just be like, readjusting or repricing their valuations. But industrials is going to be very like Main Street economically related.
That's what I would have guessed, right?
XLY, we have a confirmed but not yet triggered weekly double top. It may trigger this week. I would not be overly aggressive looking just yet on the short side. I'm watching for a slight bounce. We're against the 200, which if you see here on the chart, last October was major resistance. We fell, became major resistance January and February, became resistance in April, built a base just below it. We broke out on May, running it higher. Now we formed that weekly double top, and we're back to that 200. I'm watching for some kind of bounce and then rollover play here. Once that breaks, again, consumer discretionary can also be a lead indicator that the markets are rolling over again. In the short term, though, we do have a potential mini double bottom, which even if that triggered, would just be setting up. I'd be watching for those levels to play out and then the bigger rollover play, because the bigger confirmed double top would not be invalidated even if we bounce.
So the XLY, people should know that's consumer discretionary. Same thing.
Yes.
It's the Spider Sector Fund, right? But
Correct.
within the XLY, 24% of the holdings of the XLY is Amazon. Okay. 17% is Tesla. So everybody should know
Jesus.
that. When you talk about consumer discretionary, so here's the rest of the top 10. Home Depot, McDonald's, Lowe's, Nike, Booking Holdings, Starbucks, TJX, O'Reilly Automotive. Those make more sense, sort of from when you want to grasp what consumer discretionary is. Amazon, though, is the largest holding in here, as is Tesla. That to me seems like the structure makers of this particular ETF wanted to ride tech.
Good,
right?
yeah,
And they
because
can
that's
make
stupid.
yeah, they
Because
can make
Amazon,
it,
everyone gets everything from Amazon now, not just discretionary shit. So
and
yeah,
Tesla?
that's
yeah. I mean, I guess
But
it's you use
AWS?
your discretion as to whether to buy a Tesla or not. I guess
No. AWS is discretionary, right?
right,
Well,
because
that's
most
the-
of it is the web services. Yeah, sure.
right, exactly.
So, yeah, so that people should know that when you're looking, you shouldn't say, "Oh, discretionary consumer discretionary is doing well." Macy's luxury goods must be up, or Gucci must be up, or not necessarily. It could just be Amazon had a good quarter.
Right.
And you bring up a good point, Bob. Before, and we don't have time to go into this, I mean, you're highlighting some things, but if I go to ETF.com, and I always, if I'm wondering what's in a, one of these ETFs, I go to ETF.com and I look up, it shows you the top 10 holdings. So you can see, just to make sure, hey, do I really want to be in this, or do I want to find another one, or do I just want to find some individual big names and go long or short those?
So here's the thing about this, as Mike's putting the next chart up. When you're looking at, say, I just want to be in consumer discretionary, you're going to underperform the XLY if we get into a bull market, just because they've got Tesla and they've got Amazon. So,
But they're not consumer discretionary. That's a flawed system. I don't like it. This is the first time I found that out, by the way. Thank you for telling me this. That the fact that Amazon's 25% of it, there's just, in my mind, it is no longer consumer discretionary. But anyway.
Theoretically, we should do a whole podcast as to what Amazon can fit in next time we do these sectors.
Anything you mentioned. Do they pay a dividend yet, or is that just Apple? No, Amazon pays you nothing. They don't pay.
No, I don't think so.
Right.
But here we got consumer staples. Mike just put up. Amazon's probably in there.
Oh, I bet.
Because you could buy paper towel from there.
By the way, this is very fascinating. Consumer staples, which had a breakdown, and a couple weeks ago closed below a very, very key level. And then my target was 68, which we hit today virtually. But if we closed last week, I shouldn't say if anymore. We closed last week below the weekly 200. The last time we closed below the weekly 200 was this was COVID. So if you think consumer staples, ran up, came back down close to 200, we're now breaking this very, very key level. I'm going to be watching for a bounce now, even if we continue lower on 66.50, but then a potential another rollover play in consumer staples. You see the theme here, bounces and then potential rollover plays unless something drastically, fundamentally changes in a lot of these sectors.
So I just looked up the top 10 holdings, and Amazon's not in there. It's more like it's Procter & Gamble, Pepsi, Costco, Coca-Cola, Target, Philip Morris, Walmart.
Is Pepsi's a consumer staple? Jesus Christ, what do we live in? By the way, if you guys have not figured out the theme of this show, with rates screaming through the roof, there appears to be nowhere to run to, nowhere to hide, unless you guys are holding out some cards you're going to flip and say, here's what you want to buy, because I don't see anything yet.
It's a nice Warriors reference, by the way.
Thank you. Yes.
XLV Healthcare? Which
see if Amazon's in there. Go ahead.
A few weeks ago triggered a substantial double top and just hit the target yesterday and today, and now we're getting close to a very key support area we're in a minor support area, but if this breaks, I'm watching. If healthcare heads lower, I'm really focused on about 125 to start watching for at least a short-term bottom, and especially if we start getting in the next few weeks / maybe a couple months, start getting another bounce top, I'll be looking more for a bottom in XLV, but we finished a short-term pattern in that, so it's sort of hands-off mode since we're down a fair number of weeks in a row. I need to see some kind of strength in there, and there's nothing yet. XLB Materials, Select Spider is just ugly. We're closing in on the area of the 200, just below where we're trading now, right around 75. I'm going to be watching for a bounce play around there. If we close back below that 200, then that won't be good. But that would be something I'd keep an eye on with a little more pullback in the materials. Select Spider again, XLB, XLC, Communication Services. And do you want to go over the holdings of this one, Bob? Well, I'll just talk and then you look that up.
Go ahead.
This one, we have a potential weekly massive double top. It has to close below 64.32 on a weekly basis, and then we could see pullback potentially to $60, which is right around the breakout zone from when it broke out. That magic May 15th. So that's what I'll be watching for if that does trigger. That would be where we talked about the NASDAQ in the beginning of the show, and I said we've built a solid support base. XLC, the Communication Services Select Spider, built a resistance base there that then becomes support. So that would also return it to that same support base that we were looking at longer term in the NASDAQ.
So this particular ETF is 24% Meta, and it's basically 23% Google. It's got 12.5% Class A shares and 10.75% Class C shares.
And it's the communication ETF?
Then you got Activision.
I guess we communicate. Yeah.
Yeah, I mean, it's weird. I remember when they moved those from tech to communications, they moved a lot.
I thought it was like Verizon.
Yeah. Well, they're in here, but they're the 10th largest holding, 4%. They've got Comcast, they've got Activision, Blizzard, Charter Communications, T-Mobile, Netflix, Walt Disney, and Verizon. Are
you looking at the right shit?
Yeah. And actually, I got to look this up. This is the XLC. These are the top 10 holdings of the XLC. I'm gonna get their documents and try and read them before that. I don't understand the Disney and Netflix at all.
Because we're not communicating through Disney and Netflix.
No.
They're communicating with us.
If anybody knows the answer to that, let us know.
I see hidden messages on Netflix and in Disney.
It's subconscious communication. If anyone knows the answer to that, reach
Yeah,
out
let
to
us know.
somewhere.
But by the way, real quick on XLC too, if you look at that daily chart, if that double triggers, it could take us straight to the 200 daily, which is all we have. All these levels are just lining up a little too good for me.
Yeah, they really are.
XLU, I know we weren't going to touch on this one, but I just want to cover it because this has gone down the crapper due to interest rates.
We're too late. Somebody got to it already.
But because it's so interest rate sensitive, you see what's happened to utilities. This is not something I'd touch until I'm looking for a bounce around here, but that's a bounce only, and then another potential leg down in the XLU. Not something I'd be chasing unless you're very nimble to the upside. That's all I have to say about that.
Wow, that chart looks like a puke.
Yeah.
You want to touch on anything
you're going to get a
Mike?
bounce or consolidation, but that's like, what is it? That's catching the falling knife pattern right there.
Yeah.
And it's red for a reason.
Is there any other ETFs you want to touch on before we have to call it?
Yeah. Like 30 more. No. Retail.
Before we do go, I'm going to ask a question. Like we went through about 7 or 8. Where do you think the most near-term opportunity is? But anyway, go on to what your next one is. Yeah.
Near-term opportunities, I'm watching for a massive double top's been triggered in SMH, which is a semiconductor index. And we know there's been some high flyers in there, especially NVIDIA, which actually hit 2 out of 3 of the double top patterns. We've bounced a little on that, but I'm watching for rollover plays in the semis, whether you look at individual things or you look to just trade the whole semiconductor ETF. I will be watching for a pullback in that continued. And you know what? This is also fascinating. And the VUG, this is a Vanguard Growth ETF, which I've used as a proxy for growth funds. We've triggered a channeling double top. So on any bounces, and we may get a little mini double bottom bounce pattern off this, but I will be watching for more growth stock rollover plays coming up in the next weeks.
For those of you looking at that semiconductor index, you could almost list the top 10 off the top of your head. It's NVIDIA, Taiwan Semiconductor,
AMD.
Broadcom, Intel, AMD, Analog, Applied Materials, Texas Instruments. It's all the usuals.
What percentage is NVIDIA?
It's a great ETF if you're looking to short semiconductors. Largest
what percentage?
NVIDIA.
And what percentage is that?
20.23.
Okay, that's interesting. Because that, again, NVIDIA might be a great story. AI is a great story. But like we said before, that these things move like a pendulum, and oftentimes they get to a price that the fundamentals in no way supports. And I think that could be the case here.
Yeah, what's still, our PDE ratio on NVIDIA is still at 108. That's a little, with AI, that's a little pricey.
Yeah.
And again, people chase performance. Yeah. And we want to be the people who notice when people are chasing performance and then try to figure out when they run out of gas.
By the way, just on NVIDIA, I know we don't cover a lot of individual stocks, but there could be a massive head and shoulders pattern forming over the next few weeks. It's not complete yet, but that could immediately take us back to the 50% level from the lows in October of 22 to the highs in August, and that level would be right around 305. So that's why if that triggers, I would not be wanting to sit through NVIDIA bigger pullback and waiting for new highs.
When that triggers, we should have like a code word that you text out on Twitter and we retweet it and short the shit out of it. Because I don't recommend it. I don't have no problem with talking about these things because I'm not, recommending anything to you. I'm just saying that I'm looking to short some things that I think are unjustly priced.
Also, by the way, if you don't subscribe to the Pat Trading Partners YouTube channel, he does do a lot of that on that. But
good, you should all subscribe to that.
Do you want to touch on retail before we go? We're running out of time, but I know you wanted to talk about that, Mike.
Where is my retail?
While he puts up, just so people know, the Spider ETF, the XRT, the retail ETF is really balanced. Like their top 10 holdings, their top holding is Carvana, and it's 2.59%. So they're not heavy in any one thing.
Good.
The lowest of the top 10 is Victoria's Secret, and it's 1.54. So it's a
And
very
I'm wearing
balanced ETF.
Victoria's Secret right now under these clothes. So you guys, yeah, it's fine.
It'll be interesting if retail holds here near this 58.85 to 59 area. We could see, and this could nicely correspond with at least a short-term market bottom. If we then bounce and get a close above 61.54, we could see some follow through and at least have the XRT get back to the 200 simple, which would be the second target on a double bottom, which is around mid 63 area. But that could correspond to at least the more of the short to medium term market bounce that could be setting up in the next week or so. So I'm going to be watching for that. Other than that, then I'm watching the probability shifted again to where we should retest the end of May, beginning of June low area that we set up this year. So we could easily see mid 55s, about mid 57 again over the next coming months after we get some kind of bounce.
Does that chart to you look one of the least bad of the one we've seen?
It doesn't look great. It looks like, hey, if I'm looking for a long opportunity in the short term, again, waiting for it to potentially trigger and it may not trigger, that's looking like it could be a decent play to the upside and then to set up for another rollover play with a weakening consumer, especially if we have crappier holiday sales or something else, or a crappy Black Friday, Cyber Monday that are coming lower than expected. It could set up for another rollover play there.
Got it. Okay. All right. I got to go. We're going out to dinner and then to a Jimmy Buffett tribute band tonight. It's Tuesday, and my wife agreed to this. I usually don't go out on Tuesday nights, and I'm not particularly happy about it. So it's kind of put me in a bit of a crabby mood. But I got to leave and go to dinner and then to a show. Michael, thank you very much.
Thank
Good
you.
to see you guys. Yeah, we'll talk soon.